Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny, Levy. Let's begin.
Everyone, welcome to Go Bank Yourself. Josh, Pinny, Levy here with Dovi Herman. Oh, sorry, Dovi,
Hello,
I stepped
folks.
on you.
Oh, you're doing great. This is your first time doing the intro. Love it.
It's Zero Night Bro. Everyone who knows every Arnold Schwarzenegger and Danny DeVito movie is going to know tonight is your night, bro. Tonight is my night to make the intro. But that was twins, Danny DeVito and Arnold Schwarzenegger.
I have not seen it. You know, you do a lot of movie references.
I know too many movie references, and I'm hereby saying that W. Herman should not go and watch Twins.
Yeah, but you said that about Goodfellas.
Oh.
And I've seen Goodfellas.
You shouldn't watch. You should not watch Goodfellas. But I believe I said that in reference to taking a policy loan versus taking a bank loan, right?
Basically, yeah.
Right. So,
F you, pay me.
Yeah, sorry. F you, pay me. Well, those who know will know. So, I really wanted to start recording at the end of our off-camera discussion. It's always so juicy. I'm sure everyone wants to know what we were talking about. We were talking about fundamentals of American governance, and governability. And John Adams said that the American Constitution, woohoo, 250, was written for a moral and virtuous people. And I said, wow, we're practically ungovernable now because the country is going in a direction for what one could tell. Take a snapshot of America, take an Instagram of America for an even worse snapshot, because that'll be the very, very best. And the very, very best with the best photography and touch-ups and screen effects shows you a very short-thinking or materialistic type of populace, but that can't be for the long run. So take off all the filters, and what do we got? It's probably even worse. And then always faithful to the country, Mr. Herman over here says, what did you say? Self-govern, that the Constitution was made for us to govern ourselves. He was on the right track, meaning government by the people.
That's right. The founding of the country was based on the idea that we should and could govern ourselves without too much central planning.
Or I'll put it in really modern terms. Hey, chat. Self-governance. Yeah, that government should be at the lowest level, except for things that have to be at the very highest level, security and intra-state commerce. But, and it clicked in my mind. Now I've grasped it again, really, that spark of wisdom. I've got it. Can we make something out of it? The type of people who really enjoy what infinite banking can do. And when we say infinite banking, we mean the infinite banking concept. See Nelson Nash's Becoming Your Own Banker. The process of building capital under extremely favorable terms inside of a whole life, dividend-paying whole life insurance policy. Fine. The people who like it, they love them some self-governance, because that's an extension of what's a little bit deeper than that is I like control. I like rugged individuality. I like to be the boss, and I don't want someone else being the boss over me, whether it's a far-off bureaucrat in Washington telling me how many gallons per flush can flow through my toilet, made in Mexico, assembled in America, or a local bureaucrat telling me what the hours of my library are, or how much for a license for my dog if I had a dog.
Mm-hmm. Expound on the control that people have inside of these whole life policies, because when I speak to, sometimes I'll talk to a financial advisor or people who are very ingrained in the conventional wisdom, and all they ever push back on is, why would I ever buy a whole life policy? It has such a weak rate of return. And while that is only a half-truth, and it's not the full story, we do not only promote whole life insurance, because of growth and rates of return. It's because of the control of capital that we have when we filter our money before it goes out for to pay debts and expenses and buy assets, to first put it in a reservoir of wealth, this filter of whole life insurance policies. So what type of control do you get when you do that first, before you go buy your cars, before you go put money in the S&P 500, before you go buy rental
Set your
properties?
401k. I mean, let's talk about the control that people, to answer. Let's talk about something and ask more questions. What people expect now, you can broadly call it the conventional wisdom, is I will save my money and take it out to spend it. If I have something big to buy, I will finance it. And if I'm going to go down that second path of financing, I know what to expect. I'm going to go expect a 6 or 7% mortgage for 30 years. I'm going to go expect an 8 to 9% mortgage for a 15-year adjustable rate. I'm going to go expect a 15% business loan, a 20% credit card loan. Or if I'm an E3 in the military and I walk across base and get a tattoo in a car, no offense to any soldier or sailor or airman that does that, but every single base has a tattoo parlor and a used car lot right across the street. And they know exactly how much an E3 can pay, and they just walk through the gates and get ready for your 23% subprime auto loan. So different loans have brackets of what to expect. That's all part of conventional wisdom. And you sign up, you sign your name, you pay the interest, back to the mafia reference for Goodfellas, you pay the VIG, you pay the interest to that financier, whether it's hundreds of thousands for your mortgage or tens of thousands for your business loan or ones of thousands. I don't know, how do you say this thing? 5 to 10,000 for your car loan, depending on how unfortunate terms you signed up for. And we're all programmed to do that. And the conventional wisdom of the American mind is, can I afford it per month? You have a secret meeting with your spouse. Does it look good? It looks good. We're going to have to spare some. We're going to have to cut back on me 1.5 lattes and you whatever per month. We'll scrimp and save. We will scrimp and save, to quote the Beatles. Go look that one up, Dovi Herman. And that we can afford it. And then the salesman says, what about the leather chairs, leather seats? Oh, man, we will scrimp and save some more, but we can afford it. And this is all, I'm explaining conventional wisdom. We can afford it, and we will now tie ourselves and bind ourselves financially to paying for that car, that mortgage, that investment property. But the expectation is I pay on schedule, and at a certain time the loan will be gone. So now let's look at, what does it mean to control that reservoir of cash? What does it mean when you have the rugged individualism to build your own bank and not rely on the types of loans that a traditional bank offers? Well, that means you take out your money. You build up your money. We've discussed many times how, yes, it takes time to capitalize. B, you apply, with air quotes, for your policy loan. With some companies that's send me my loan. Other companies it's click, 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 send me my loan. Others it's, hey, Pinny, hey, Dovi, do my paperwork and send me my loan. And 2 to 3 business days later, you have your loan. But now what happens is vastly different. There is no monthly requirement to pay. There's no annual requirement to pay. If you're a little overextended or cash is a little short, you don't have to stay on any schedule at all. Even if, using better judgment, you created a schedule or you asked us, hey, my agent, help me conceptualize what this loan should look like. Very often the answer is, how much did you expect to spend on that Mustang? Here, I'm on the phone. $650 per month. So go ahead and pay yourself back $650 per month. What if I come to a bad month? Well, who holds the loan? If some other bank holds the loan, you could be in trouble. If it's an IBC loan, then you have all the cards. This is where control matters.
But
this
Penny,
is where I don't have to pay.
why don't I just take a loan against my stock portfolio or a home equity line of credit. I could
You're,
do the same thing, couldn't I?
you're baiting me, aren't you?
Of
Well,
course. Well,
with
that's
either,
how often do you hear that pushback from very competent people
yeah,
much smarter than myself?
way smarter than me. Because listen to why I say smarter. A guy who says smarter like that can't be very smart. Well, yes, they could. No offense to anyone from Boston.
Yeah, I think Boston's like the most intellectual city in the country. So
You got Harvard. So, and you have Southie. But I love it. The inside joke is joking how my accent, the accent of my youth.
oh, that's right. You're
Um,
from Boston. I forget that.
that's right. That's right. I used to have a wicked harsh accent. So the the typical take a stock portfolio loan. First of all, hey, log in and see how much you have in your portfolio. What's the value today? Oh, the stock market's nice and high. So look at this. I've got $100,000 of value of my stocks today. Okay, now go take a loan from that. What do you think is the typical loan from a pure stock portfolio?
It depends how much you have in there. Anywhere between right now, just based on what I've seen from SoFi, I have not done this myself. To get a really good rate, I mean, you have to have like upwards of 5-10 million to get into like the 4.5. But if you're talking under 50K, under 100K, it's like 9.5 right now.
And that's
And that would be
talking about
amortized.
APR.
Yeah.
So there's and different things to consider. What is the APR on that loan? That's fine and dandy. The second thing is, well, how much can I borrow against a $100,000 portfolio? So the answer is as low as 25%, depending on situation.
I do think most places are 50, to be fair.
So if the value of my portfolio were $100,000, to be fair, I can borrow safely 50,000. But now I'm on terms of the lender. Now I have a schedule. And now I have a monthly amount of money to pay back, a loan repayment. I also have contingencies if I can't pay. In the case of a stock portfolio, the collateral could be more stock or future value of that stock. Check me if I'm wrong. In the case of, what was the other type of loan you said? Why
A
can't I
HELOC,
just,
home
a
equity line
HELOC?
of credit.
Right. In the case of a HELOC, well, the starting value is going to be the equity in my home, that amount, the value of my home, the current value of my home above and beyond my the amount left on my mortgage. And even then, there are monthly minimums to abide by.
And
So,
that's if banks are lending. That's if banks are lending to you. There is a long application process based on your income and employment history. HELOCs sound like a great financial tool if that's your best option, but it is not nearly as simple as going online and not even requesting your loan. It's demanding your loan.
yeah, yeah, exactly. And that's regardless of credit score, regardless of current income. I mean, if you took the time to build a $100,000 portfolio and a $100,000 cash value within your life insurance policy, and then lost a job, and went to both of those, and number C or a letter C will be a HELOC, a bank. You know, the very first question for the stock portfolio and the bank is, how are you going to pay us back? The life insurance company asks no questions. You're the banker. You're the one that has to say, either I plan to pay this back, but I don't have to tell anybody, nor can it hinder my ability to borrow my cash value right now. I don't have to tell anybody, nor do I even technically have to pay it back. It would be economically silly not to, but ultimately, the ultimate collateral is the death benefit.
Hmm.
My $100,000 loan for a whatever, an investment project, a housing flip. I could ignore that for 50 years and then owe $10 million. Well, as long as, and designed the right way, it will be the case. As long as my death benefit is greater than that, say my $12 million death benefit will pay off that very poorly managed $100,000 house loan, and now there's 2 million, not 12 million, going to my beneficiaries.
A
Extreme
fellow
case.
financial professional pushed back on me and
Mhm.
said, "Why would the insurance company do this? Don't they have better investments to make than just lending me?" And the very simple response that I gave is a policy loan is the safest investment a life insurance company can make
Mhm.
because they are guaranteeing the collateral of that loan. They guarantee the death benefit. The ultimate collateral of the loan is the death benefit.
Yep. And they actually have less liability if that loan is paid back upon death, rather than, meaning, my example, stick with that example. Hey, this Joe died, Joe's death benefit's 12 million. Yeah, wait a minute. Joe had that $100,000 car loan 50 years ago that's now 10 million. So send Joe's beneficiary the 2 million that's left over. So it's at that point in time for the life insurance company, that's a $2 million expenditure and not a $12 million expenditure. So, I mean, picking nits, but yeah, the reason it's a safe loan is, well, they know that if paid, they're collecting an interest rate. We can never get around infinite banking, sold by people on TikTok who are much, much more handsome than me, or much prettier than Dovi. They might tell you that infinite banking means you take a loan and you pay yourself back and you make the interest. On some levels that is approaching the truth, but we don't want people to think that when you pay a life insurance policy loan back, you yourself, the policy owner, are profiting from the interest payments. It's not true. The life insurance company is. Why? Because it's replacing the profit they would have made in their bond investments. In my example, they invested 100,000 less in bonds that tranche that year, and they sent it to Joe. So the remuneration for them, the profit on that loan, the interest that Joe is charged, whether he pays it or not, is what would have replaced the bond structure that the 100,000 was intended to go into before Joe said, me first. I get the money first. And he has full access to that. It's another thing. Your bank
So
with
are the insurance companies going to change the rate of interest that they charge on policy loans based on what they think or what they know they could get in their bonds investments?
No, that's not the deciding factor. Is that the answer you're looking for?
No, it's just a question.
It's not replacing the profits is not the benchmark. The benchmark is some companies, Moody's, some companies, they'll take a different national index and tack on a few basis points, and that's their loan point. That's their current loan rate. So, and that's to be, for full disclosure, that's variable. With most companies, they have the right to change the loan rate on new loans every month. So you might take a loan out at 6.5%, and a year later, if you chose not to pay it, the new loan rate might be 6.75. Your loan rolls over at 6.75.
Mm-hmm.
Plus any interest.
There is a contractual limit to how high they could make policy loans based on your contract. I believe new contracts right now are around 8%. I think my policy is 8%. That could be the limit.
Yep, there is. And there's fine print on it, but as a general rule, yeah, they do max out at a certain point. So, but back to the entering argument here was, if I have no income, well, when I go through the application process for my stock portfolio for a HELOC, even for a new car, well, that's going to reflect on the application. And they have the right to say no. Even these days, for an apartment, you've got to prove up your income to rent an apartment these days. I mean, that's been backed by law, at least in New York, Florida, for many years now. Hey, you want this apartment? You've got to show 40 times the rent as income. Ever heard of that one?
I mean, I see like 2.5 to 3 times
No, I remember clearly being in Riverdale, New York, aka the Bronx, looking for a new apartment, and them saying, "Yeah, what's your income?" Well, the rent here is 2,000 at the time, so you've got to make $80,000.
What? I'm
Yeah,
currently looking for an apartment, and I'm seeing they're always looking for 2.5 to 3 times income. So if we're gonna rent somewhere for 2,500 a month or 3,000 a month, they want to see between
oh, on
you
a
know
monthly basis, on
eight
a monthly
and
basis.
9,500.
Fine,
Oh,
fine.
you're
No,
thinking
I was
annual.
talking about annual basis, right? That's what I meant.
Okay.
Yeah, yeah. Okay,
All right.
let's
So
get
similar numbers then,
yep,
proportionally.
yep. And but where are you going to find $2,500 a month in LA? You got to go.
No, in the va not tier one apartments, but there's some decent stuff for 25.
Very
Rents have
good
come down a little
all
bit since
for
last
real
year.
estate renting tips. Dovi Herman knows the market, so speak to him first.
Zillow is you can learn a lot on Zillow.
Yep. Um, for tips of how to find that perfect two-story house with a basement in South Florida, just kidding. They don't exist. No basements here. So, wait, do you have
Very
basements in
very
LA?
here.
There are
Say it again.
not? Do you have basements in Southern California?
I've seen. I don't know if they're like the same types of basements that you see in New York,
Hmm.
but they're few and far between.
That was a real shocker for me coming down south of Annapolis for the first time and getting to where was I? Perdido Key, Florida. Yeah, and, even in the Panhandle. Um, no, we had basements. We actually had a basement in right on Perdido Key, which is like just before you hit Alabama. Beautiful, beautiful, beautiful place in the Panhandle of Florida. So man, wouldn't mind to be back in the Floribama right now. It's a bar that's like right in the border of Florida and Alabama. So it's named the Floribama. The things you get on this podcast are, bar none, the most
Would that be where
important.
like Pensacola is?
That's exactly where Pensacola is. Yeah, the most
Tallahassee.
important useless trivia that you could have. No, not Tallahassee. It's further west.
Now that we're talking about absolutely nothing, what were you talking about with the Beatles? I know pretty much every Beatles lyric, and that did not make any sense
We
to
will
me.
scrimp and save. If you have to scrimp and save to prove up for a loan, right? Whatever we were talking about from
Yeah.
when I'm 64. So we will scrimp and save. Grandchildren on your knee, be rich on
Hmm.
the day. And you got to go when you. So
Okay,
but the problem is you're not
I don't
older.
remember
You're
that
not
phrase.
older, and you're not losing your hair, so you can never relate to that song yet.
Not yet.
When I get older, losing my hair many years from now. So and you're not going to lose your hair over someone telling you, "Hey, you got to pay back your life insurance policy loan," because there's no one telling you to pay back but your inner voice or your agent, Dovey or me, if you have a good agent who's reminding you, at least on a periodical basis, "Hey, you got a loan out. What's your plan?" Nelson Nash wanted you to have a plan for yourself and your family. You want to have a plan of repayment, even if the
Hmm.
plan is, "I'm just going to pay the interest for a couple of years and then I'll work on the principal." Um,
Sure.
as long as there's a plan. Um, and again, not required. It's not in the contract. You don't have to tell anybody about it, but you want to be able to address those loans because while you're in accumulation in life, while you would have, if you're going to borrow money for a car or for anything, you generally have a plan to pay it back. Well, no different with your bank, with your life insurance policy loan, with your bank, your infinite bank. You want to have a plan to pay it back.
Right. If you're going to respect the bank's capital and
Respect
pay
your own
them,
capital.
you should
Perfect.
respect your own capital and make sure
Perfect.
that you're paying yourself back. And remember that when you pay yourself back, pay your policy loan back, pay yourself back, you
Replenish.
nearly every dollar that you repay, dollar for dollar, becomes liquid in your policy again. So it is another form of savings. You're really just building your fund back up. What a
Yep.
policy loan is there is now a lien against your cash value, against your equity. So it temporarily becomes illiquid. And as you repay policy loans, that lien comes down. And now you are liquid again.
All that is by way of saying who enjoys this? Someone who wants control, someone who wants self governance of their finance. Hey, that's the way to say it for for the 250th birthday of the country. Self-governance of your finances is infinite banking. If it weren't unprofessional, you'd see me writing it down right now. So
Yes. Celebration of the 250th anniversary of America. Sometimes it sounds like we might be unpatriotic, un-American. I think Pinny and I can both say we do love, value, and respect this country. It is the freest place in this very unfree world. Um, but there are a lot of improvements that can be made. In the last 100+ years, the freedoms that Americans were able to enjoy for most of this country's history just do not exist in the same way. And that is, to be a broken record. I'm not going to apologize. I'm not going to say sorry for being a broken record. To be a broken record on purpose, because this is the truth. If it weren't for the Federal Reserve and the IRS, this country would be a much better place.
we'd have more sound money, that's for sure. Well, what we do with the sound money without the IRS and Federal Reserve, that's still up to the people. We were talking before hitting record about John Adams, who said the country was made, the Constitution, it's written for a virtuous and moral people. So if you, back to the Instagram, if you take the very worst, the unfiltered, the raw cross section of materialism and lack of a moral standard, well, that type of populace is not going to do well with sound money or with unsound money. Adam said, vis-a-vis government, if government is in control of one person, you have a tyranny, or a monarchy, a tyranny. If it's in the control of a few people, you're going to have an oligarchy. But if it's in the control purely, like pure democracy, in the control of the people only, well, then you've got mob rule. That's either three is a bad thing. Regarding pure democracy, I might have made the joke before, maybe not for the podcast, but what do you call, pure democracy is two wolves and a lamb voting on what's for dinner.
Mm-hmm.
Right? It's basically mob rule. Who's going to win?
Right.
Unless it's super lamb, then the wolves win and it's lamb for dinner. The wolves win the vote. This is what happens when you can vote other people's tax money to go to yourself. This is why politicians make campaign promises, is because that gets the largest amount of people paying attention and voting for you when you're making promises to them, especially from someone else's money. So sound money can't fix those problems, but you know who likes the infinite banking concept? Not just people who are rugged individualists and they understand that self-government applied to finances is infinite banking, but people who are thinking long range, spiritual people, someone who says, wow, it's not just me, but it's my progeny. It's those who come after me. I want my children and grandchildren to succeed. Why don't I set up this intergenerational system where if I can't spend it all, and if you really play the cards right, not even playing cards, that's chance. If you utilize infinite banking, you will have more death benefit than you can spend. It's gonna flow to the next generation. So if they're trained, your children, and even more so your grandchildren are trained in what to do, then you've created a virtuous cycle of money and not a vicious circle of living month to month or generation to generation.
And to go deeper on what you said, that if your children and grandchildren are trained on what to do, this would mean they have their own whole life policies set up and they've been buying cars and investments and whatever they're doing in their financial life, incorporating the infinite banking concept, this strategy, and they probably have policy loans out themselves. And when they get this death benefit, that is a windfall coming into their lives, a large chunk of money that they didn't know when it was going to come, but they knew that it was going to come. Yeah. And now it goes right back into their policies as policy loan repayments.
Yep, a bittersweet eventuality. David Stearns, who's the president of the Nelson Nash Institute, a son-in-law of the late Nelson Nash, told the story when Nelson Nash was near his last days, called all of his family and asked them, tell me about your policies. In his book, you've got to read Becoming Your Own Banker. He has a chapter called The Grocery Store, where he describes the virtue of being a captive customer of your own bank. Well, he says, in the analog, if you owned a grocery store, of course you would shop there, and you'd tell all your family and friends to shop there. And not only would you shop there, but you'd pay retail. You wouldn't go out the back with a can of peas. Don't steal the peas. He also says you wouldn't just pay retail, you'd pay a few cents more than retail, because over time your books will be even better than anyone else, any other grocer on any other corner. That's the idea of paying more interest per loan than what's actually being charged when it makes fiscal sense. But the catchphrase was don't steal the peas.
What it means, don't steal the peas, is, let's say it cost the grocery store owner 57 cents wholesale to get a can of peas, and they're selling it for 60 cents. So that's not a very good margin, but once you turn it over once you break even after turning it over that 19th time, and once from there you're off to the races, amounting an insane level of profit. But, well, if you steal one can of peas, that means you have to turn over that can another 19 times just to make up for one can being stolen.
Right. So David Stearns relates that Nelson Nash asked him, have you stolen the peas? Meaning, did you take policy loans without plans on paying them back? And he said, yeah, Nelson, we stole the peas. We're about 400,000. We owe about 400,000 on various loans that we meant to pay back, but haven't gotten around to yet. Nelson Nash said, good. Here's a guy with 40 plus life insurance policies. Can you imagine the amount of death benefit? He said, I'm going to make everybody whole, to Dovi's point. He made every single living relative whole for any policy loan, and then gave them the ability to max out the optional cash that they could put into their policies, to a man. So when we're thinking intergenerationally, like Dovi said, there comes a time when, okay, I might have a policy loan out, but that first generation has the largesse. Not that we plan on that, but as a bonus, if someone got into trouble, got behind repayments, well, when you're in this family business, this family banking business, help is on the way with the next generation, with the changing of the guard. So
can you imagine how some of these people must have felt having 10, 15, 20, 30-year policies, being made whole, knowing and seeing that they're at the point where every new dollar they're putting into their policy, they're seeing anywhere between 30 and 300% cash on cash returns on a nearly guaranteed basis.
Trying to Dovi Herman appeal to the longevity and the how lucrative life insurance policies all grow to be when they're designed for infinite banking. That there's a short-term illiquidity, meaning I can't put in $10,000 and expect to borrow 10,000. There's always a holdback period. Ask your agent to explain it to you, but there comes a time when every new dollar is $1.40, $1.50 as instant liquidity. It goes into your policy and creates that much more cash for you to borrow, and you just can't get the regularity of a mature life insurance policy. There will be times when that aforementioned stock portfolio will be doing gangbusters, but that's an if, not a when. And that's also subject to taxes. It's also subject to loss. It's also subject to recovery time after a loss.
And ultimately, it's not a great tool for banking. And we are talking about incorporating a strategy where you mimic a bank and take control of the banking function. And while a stock portfolio may be great for accumulation and with the right strategies may distribute into a very nice retirement supplement or a retirement plan, it's not a great tool for banking during your working life.
Yep. Yep. Round robin, lightning round. Who else likes the ideas of infinite banking? We talked broadly about two different types of people who are apt to enjoy, to want to look into the infinite banking concept. Someone who is a rugged individualist. They like control. They want to control their bank. Or someone who's spiritual and thinks long range, long term. It's not just for me, it's for my children and grandchildren. I'll give you some other symptoms of who might want to look into the infinite banking concept and contact Dovi Herman or myself about looking into setting up a policy. That would be someone whose symptom is when they say everyone's doing it, you cringe. You say everyone's doing it is not a reason to do something. And what is everybody doing? Max out your 401k, max out your IRA, go open up a high yield savings account. This is just conventional wisdom and vanilla cookie cutter financial advice. If it rubs you a little bit the wrong way, you want to look into the infinite banking concept. By the way, this is a little bit of a thin wire, but if they say line up and take the shot, and you say line up and cushion tuchus, can we say that on the air?
We can, but I'm not sure what you're getting at.
I'm saying that if the experts say do it, you know, the hair on your back goes up and you say, I'm not doing it just because some expert says do it.
Your intuition might be telling you something.
Yeah. So translate that to finances. That's who enjoys this. And it's not because it's new. It's because it's older than the new conventional wisdom. It's older than the Wall Street paradigm of investing or the government intervention of retirement savings to delay paying taxes, to defer taxes. It's older than that. So you just might have these symptoms of something that's instinctually looking for, well, what predated that? Well, that was life insurance and the things you can do with it. So I don't know if you want to throw out any more symptoms there. If you're listening to Bruce Springsteen and when they said sit down, I stood up, growing up, greetings from Asbury Park, you might be a candidate for infinite banking. Just, you know, don't have the politics of Bruce Springsteen necessarily.
Maybe not.
Did I totally lose you on that one, Dovi Herman?
No, I know he's a raging lib. Maybe that's not a nice thing to say.
It's not. No, yeah, right, that's right. The idea is going. The idea of when they said,
if you are good with going against the grain. I reached out to a business owner the other day, and I told him that, you know, let's follow up on this conversation that we started. I'll teach you how to set up your own private line of credit that you own and control. Just know that if we're going to do something like this, this is going against what most people are taught, and you'd have to be comfortable going against the grain. It's crickets for now. I don't know, you know, maybe I'll follow up again. But I wonder if that sparked something to be like, I am someone who wants to go against the grain, or I'm definitely not someone who wants to go against the grain.
Yeah, well, so if we made the theme song of this episode Growing Up by Bruce Springsteen, again, from Greetings from Asbury Park, like 1978, go figure. I hear that he's very protective of his intellectual product. So don't make the theme song of this podcast "Growing Up" by Bruce Springsteen from Greetings from Asbury Park from back in the 70s, because YouTube will shut us down. Yep.
This is a great episode talking about control within these systems of policies, and what types of people would want to get involved in this. To be on theme, on brand of US 250, the idea of the frontier, the adventure that moving and traveling across the US meant back in the late 17 and throughout the 1800s, that's what America was about. Taking control of your own life, going on an adventure, going against the grain. I think there's a lot connected there, but with a lot less risk. There's no risk involved here.
If you get an infinite banking policy, you might find yourself buying a shotgun. I'm just rolling on you. I'm just going with your analogy. It's not necessarily true, but if you're
No problem with guns, but I don't know if I'm gonna get one. My wife would definitely want us to. I would need some serious training first.
We support the three precious metals, right? Gold, silver, and lead.
Right.
Exactly. So, all right, guys, I'm Josh Levy.
Dovi Herman. Appreciate you all as always. Thank you for sticking around. Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.